Hello, everybody. Welcome back. This is Hungry for Moat. And this is me, Prabhat, and Avinash enjoying a hot beverage like we all should be doing in this cold time of the year.
That's right.
We have been covering the Buffett partnership letters so far, starting in 1957. Today, we will be covering the first half of 1963. Just to kind of recap quickly, 1962, that was probably one of his longest letters, especially the last letter of that year. And he went over again his investment style. I really encourage you to go read that letter if you only want to read one letter to get the most information about what Buffett's philosophy had been. He does discuss, Dempster, the middle company, how it operational wise, he kind of stripped it down to like the core, which was making money, and kind of sold a lot of other stuff and turned it into like an investment vehicle for similar to partnership. And partnership owned 70% of Dempster. And again, it was the year when he first bought into Berkshire. He didn't disclose that in his letters, but we, it's in the public domain now that he had made that purchase. And finally he moved out of his bedroom
Mm-hmm.
after managing 9 million or $10 million in assets at 1962, and he
Mm-hmm.
has an office now.
Yep.
We talk about lean, like that's how you keep your costs down.
Yeah. Incredible. And
Incredible.
and have to say his returns are killing it right now compared to the Dow. He's I think averaging 25%. Is that correct, or is it more than
Yeah, I
that?
mean, theme continues to be, an average person has three kind of choices here to invest. They've mutual funds, which is probably the most terrible way to do it. I'm still not sure if they had index funds, but if not, like just buying the Dow, that's applaudable. According to Buffett, he just thinks Dow is a worthy adversary to beat. And yeah, I mean, he continues to just dominate it. I mean, he is his personal goal is on average, 10% better than the Dow, but I mean, he's doing much better than that.
Yep. Yep. That's
And
right.
he doesn't think he's getting too big. He thinks he can still find opportunities. The increased size, actually, he's thinking is helping them find more opportunities where he can get greater control of certain companies. And he talks about his, uh, you know, um, basically the three categories. Two of them I think are similar: the generals and the controls that are similar, and then the workarounds where he feels very sure, so much so that he's
Workouts.
workouts, exactly, spin-offs, workouts, where he's actually borrowing money on millions of dollars to do these bets, and he feels comfortable borrowing because he's the certainty in this situation is pretty high. Granted that the upside is slightly muted, but
Right.
that's okay.
Yep. Incredible. Yeah. Let's maybe get started with
Yes, let's get started.
1963 July 10. Um, Okay, so first half performance. During the first half of 1963, the Dow Jones Industrial Average, here in after called the Dow, advanced from 652.10 to 706.88. If one had owned the Dow during this period, dividends of $10.66 would have been received, bringing the overall return from the Dow during the first half to plus 10%. Our incantation has been one, the short term results, less than 3 years, have little meaning, particularly in reference to an investment operation such as ours that devotes a portion of resources to control situations. And two, that our results relative to the Dow and other common stock form media will be better in declining markets and may well have a difficult time just matching such media in bubbling markets. So basically, here saying, only judge me after 3 years. After close to 5 years, and 3 years is too short. And then the second thing is, when it's bullish markets, expect our returns to be lower, even though that's not historically been the case. Okay, so nevertheless, our first half performance, excluding any changes any change in Dempster valuation, and its valuation did change. I'm saving this for dessert later in the letter. Was plus 14%. Interesting. So Dempster went up 14%. This 14% is
No, no,
computed.
no, 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 not
No,
Dempster.
the
Their
valuation of
performance.
Dempster.
No,
Oh,
no, no,
okay.
excluding Dempster.
Oh,
Their
oh, I
performance in
see.
first half.
Okay, you're right. You're right. So excluding what happened with Dempster. So I'm guessing if it's dessert, I bet you it's good news for Dempster. But
Yes.
there were plus 14% excluding Dempster. Okay. This 14% is computed on total net assets, not non Dempster assets, and is after expenses, but before monthly payments to those who take them, to partners, and allocation to the general partner. Such allocations are academic on its interim basis, but if we were also plus 14% at year end, the first 6% would be allocated to partners according to their capital, plus 3/4 of the balance of 8%. So 14% minus 6%. Or an additional 6%, given the limited partners a plus 12% performance. Okay, so despite the relatively pleasant results of the first half, the admonitions stated 2 paragraphs earlier hold in full force. At plus 14% versus plus 10% of the Dow, this 6 months has been a less satisfactory period than the first half of 1962, where we were minus 7.5%, versus minus 21.7% for the Dow. You should completely understand our thinking in this regard, which has been emphasized in previous letters. Kind of makes sense, right? So this, I think he's just saying, when we had a down, we were more protected here. Compared to the Dow, which was 22%, we're kind of at 7.5%.
Yep. Yep.
Yep. Okay. During the first half, we had an average net investment in generals, which are long positions in generals minus short positions in generals. So he does have shorts. Interesting. Okay. During the first half, we had an average net investment in generals of approximately $5.2 million. Our overall gain from this net investment in generals, for a description of our investment category, see the last annual letter, was about $1.1 million for a percentage gain from this category of roughly 21%. This
This is the
again.
first six. Oh, sorry. Continue.
No, go
Continue.
ahead. Go ahead.
Yeah, I mean, like this is the first 6 months. That's a pretty good return from the generals category. I mean, that's
Yeah,
ridiculous.
yeah. So I bet you. I mean, this is what I would like to think, that the shorts positions that he has were probably less than his long positions.
Yeah,
Yep.
yeah. I mean, yeah, that's how general strategy is. Usually, people do like these hedge funds will have 95% in long positions, and then 5% or less would be in shorts, and that's
Oh.
just to creating an insurance type situation if the market goes down. Like it won't be heavy losses, and that's the hedge in the hedge fund.
Oh, interesting. Okay, I didn't know that. Okay. This again illustrates the extent to which the allocation of our resources among various categories affects short-term results. In 1962, the generals were down for the year, and only an outstanding performance by both of the other two categories, workouts and controls, gave us unusually favorable results for that year. So, just a quick clarification here. So, does this mean that all three categories are doing well for Buffett right now?
Sorry, dumpster. Sorry, the generals definitely are. Um, but yes, I mean all of them are because controls and workouts
Yeah.
as well. But I'm trying to figure out why did he have 14% then, as opposed to much higher. Something is not. Something lowered his returns.
Yeah. Yeah. I mean, yeah. Okay, maybe he'll talk about it.
No, no, no. He's talking about last year. He's saying 1962, workouts and controls did better than generals, and in '63, generals have done better so far. I think.
Okay. 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 Now this year, our workouts have done poorer than the Dow and have been a drag on performance, as they're expected to be in rising markets. Okay, so workouts have done poorer. So this again is the spin-offs, right? Workouts. Okay.
That's right. That's right.
Okay. So while it would be very nice to be 100% in generals in advancing markets and 100% in workouts in declining markets, I make no attempt to guess, of course, uh, guess the course of the stock market in such a manner. We consider all three of these categories to be good businesses on a long term basis, although their short term price behavior characteristics differ substantially in various types of markets. Um, we consider, maybe I'll finish this, but I do have a comment about that. But we consider attempting to gauge stock market fluctuations to be a very poor business on a long term basis, and are not going to be in it either directly or indirectly through the process of trying to guess which of our categories is likely to do best in the near future. Okay, I think this is interesting. So, correct me if I'm wrong, my understanding is that in advancing markets, it'd be really nice to be in generals, and then in declining markets, it'd be great to be in workouts.
Yeah, declining markets, you need to be in workouts, and advancing markets in generals. Correct.
Okay, uh, so really, so he's saying, why
But
not
he's
be
saying
100%?
I can't time the
Yeah,
market, so I'm just gonna do whatever
yeah.
comes my way. I want to do a lot of generals, but by definition, in expensive markets, I'm not gonna be able to find a lot of generals.
Hmm.
And in that case, I'm just gonna invest in spin-offs as he
Yep.
finds them.
Okay. Interesting. So let's maybe talk about today's market. So we're in a pretty bullish market. So does that mean that anyone who are in generals would probably make more money than if they were to go into spin-offs?
Yeah,
Okay.
that is correct.
Okay. And remind me again the definition of generals.
Just general stock market, you can think of
Okay.
it like that.
Okay. Okay. Very
Like
cool.
index funds are doing great, but I
Yeah.
mean, if you want to look at certain mergers and acquisitions, certain companies that are coming off, like L Brand is spinning off Victoria's Secret into its own thing,
Mm-hmm.
or IAC, which owns a lot of the internet companies that keep spinning off. I mean, all those, like, you can go in there and be in these companies around these spin off settings
Mm-hmm.
that can, that can give you expected returns. And they may not be great. I mean, like this index funds in the past year or two have, probably more than doubled.
Mm-hmm.
And I mean, the spin offs are not going to do that for you.
Yep. Yep. Makes sense. Okay. So investment companies shown below are the usual statistics on a cumulative basis for the Dow and the Buffett Partnerships Limited, including predecessor partnerships, as well as for the two largest open-end mutual funds and two largest closed-end investment companies, following a diversified common stock investment policy. Okay, so let's look into this. So um, here he's comparing the Dow for the multiple years with an annual compounded rate compared to the other hedge funds out there. Um, so you can see maybe if we skip down to
I
the
mean,
end.
clearly, yeah, yeah. I mean, it's beat all of them.
That's right.
The
That's
Dow,
right.
Dow has beat.
Yeah, that's right. This one comes the closest, Tricontinental, but yeah, still 9.3. Okay, let's see Buffett's now. So he compares Lehman and as well as the partnerships, and the limited partners. So this is what you would be getting if you're an investor, and then this is what Buffett would get as a return. So annual compounded rate compared to 9.3, which is the Dow, 26.3 for Buffett.
Dude, that's like, again, 26. No wonder. I think Pariah just stole that from there. Like, it's just, you just keep seeing 26, 26
Yeah, yeah, and 21% if you are a
partner.
partner. Incredible. Yeah, that's right. So kind of doubling, more than doubling your investment if you went with Buffett, or about doubling, I guess, if you're just a limited partner. Interesting. Any other comments here?
No, I mean,
Yeah.
compared to the Dow, these are Oh, this is annualized. These are just averages since, if you were in it since the beginning.
Yep, that's right.
Yeah, he's not singling out performance 1963, but he's saying since 57, we've been doing great, which is true.
Yeah, that's right. I'm trying to find a year where some of the uh, other folks did better, and I'm struggling to find that. So, like, even on a year, uh,
I mean, it's
like,
certainly positive that maybe the Buffett started in 57. Maybe that was coincidence. I'm sure there'll be times where
some of the
I
other
think
guys
there
did a
have been
lot.
times where the some of the other mutual funds have done better than the Dow.
Yeah,
Not
yeah,
better than Buffett, but better than the Dow.
yeah,
And those have just been temporary
yep,
happenings.
yep. Interesting. Okay, some footnotes. Computed from changes in asset value plus any distributions to holders of the recorded during year. From 1963, Moody's Bank and Finance Mutual from 1952 to 63 estimated for the first 1963. For 1957 to 61 consists of combined results of all predecessors limited partnerships operating through the entire year after all expenses, but before distributions to the partners and allocations to the general partner. For 1957 to 61, so right here to right here, compounded on a basis of preceding columns of partnership results allowing for allocation to general partners based upon present partnership agreements. Okay,
Yeah.
yeah, maybe getting to this, I just want to kind of make a comment here. If you are a hedge fund, I think this would be the best way to let your partners know how you're doing. This is the real litmus test here, right? So, like,
Yeah,
if you
being this open, comparing
yeah,
yourself to,
right,
what the index is doing, what their other peers are doing, and to what
yeah,
we're doing.
that's right. Yeah, all you have to do is show this thing, and if you're an investor, you can know where you stand with Buffett. So that's
Yeah, yeah, I
pretty dang
agree.
good. Yeah. Okay. The results continue to show that the most highly paid and respected investment advice has had difficulty matching the performance of an unmanaged index of blue chip stocks. This is this in no sense condemns these institutions or the investment advisors and trust departments whose methods, reasoning, and results largely parallel such investment companies. This media perform these media perform a substantial service to millions of investors in achieving adequate diversifications, providing convenience and peace of mind, avoiding issue of inferior quality, etc. However, these services do not include, and in the great majority of cases are not represented to include, the compounding of money at a rate greater than that achieved by the general market. Any thoughts here?
Yeah, still, I mean, pro index funds, unmanaged index funds are do better than usually big institutions managing, mutual funds.
Mm-hmm. Yeah. One other thing that I should mention as well is this is a very lean operation that Buffett is managing. But if you compare against some of the other partners, right? Like here you have Lehman. These are Tricontinental. These guys are pretty big. So I'm guessing it's multiple people. So maybe the like the concept of, like, you managing your own money instead of having multiple people being in the kitchen might actually be advantageous, so that you can not get distracted by other people's thoughts.
Assuming what you're doing is correct.
Yeah, assuming you're assuming you're Warren Buffett.
Yes.
Okay. Our partnership's fundamental reason for existence is to compound funds at a better than average rate with less exposure to long-term losses of capital than the above investment media. We certainly cannot represent that we will achieve this goal. We can and do say that if we don't achieve this goal over any reasonable period, excluding any intense speculative boom, we will cease operation. Dempster Mill Manufacturing
Wait,
Company.
so he
Yep.
does say, like, if there's a extensive speculation boom, then please don't expect us to do, like,
As
I mean, there'd
good.
be two things. People will might he will not outperform the market. He
Yeah.
will lag behind, and also certainly possible that the people will pull out their money and chase the bubble.
Yeah. Yeah.
As a result, the partnership might suffer.
Yep. Yep. Um, okay. So now I think it's the dessert time. So Dempster Mill Manufacturing Company. In our most recent annual letter, I described Harry Bottle as the man of the year, if this was an understatement. Last year, Harry did an extraordinary job of converting unproductive assets into cash, with which we then, of course, began to invest in undervalued securities. Harry has continued this year to turn underutilized assets into cash, but in addition, he's made the remaining need assets productive. Thus, we have had the following transformation in balance sheets during the last 19 months. So, this is just for Dempster, and we're looking at how it's performing. So this is kind of how Buffett's valuing it. So he says the book figure right now, cash is
And
166.
this
So
is old one. This is
oh,
not the
that's
new one.
right. That's right. Okay. Okay. So where we ended up was somewhere 35, right? So 35.25.
$35 per share, so about 60,000 shares,
Yep.
and it sounds like they have sold off a lot of crappy assets and use the money to make smarter investments.
Yeah. So we should be seeing in the next page where it is now. Let's see. Okay. November 30th, 1962.
That's also an old one. It's just 2 years
That's
ago,
right.
and this is
60
six months.
dollars.
6 months from when he's writing the letter.
Yep. That's right. And he has the, Harry Bottle now in charge, and you can already see it's close to, I guess, $51.26. Okay.
Correct, and that was November 30, 1962.
That's
And
right.
he had raised it to 51 by selling a lot of things, so just generating cash.
Yep.
And
And then let's see. Now this should be 1963, November
I don't
30th.
know how he's talking about November 30th. Maybe that's a projection because the
Could
letter is
be.
being written in June or July of that year.
Very good point. Yep.
But I mean, you're seeing $64 amount here.
Yeah.
Um,
64.
$64. Yep.
Okay. Interesting.
Um, I'm trying to see if there's anything we should highlight. There's a lot more cash, obviously, in 1963. He has 140,000 cash from 60. Inventory is considerably down. I mean, gotten rid of so much inventory.
That's right. Yeah.
Accounts receivable has increased, so that means they have created more people need to pay them. I think maybe they're operational and they're doing things, running the business. And their marketable securities,
Mm.
I mean that's just gone up. That's the one. No, like what? 1 million, 1.7 million
Yeah. What are market securities?
stocks.
Stocks. Okay. Okay. So they did a buyback, or is that?
No, other companies that Buffett's buying.
Okay. Okay. Gotcha. So this is really the lifeblood here. That's what's making the everything look good.
Yeah, I mean look at total assets. They're saying $4.5 million in total assets, and of that 2 million is in stocks
Yep.
of other companies.
Yep. That's right. Incredible. Okay. So it's not really this Harry guy or Henry or whoever who's doing the saving. It's actually Buffett, isn't it? Because he's really doing the investments here.
Yeah, I think Harry is just giving him the cash. He's
Yeah.
just worrying about leaning down, getting rid of the waste of the business,
Yeah.
getting Buffett the cash, and then Buffett is investing or telling him to invest where. Yeah, I don't think so. Capital allocator is still Buffett,
It's still
but
Buffett. Okay.
but operation for the business is this Henry guy.
Yeah. So
Harry
really,
guy.
Buffett should be patting himself on the back here, even though he's giving all credit to Harry.
No, I mean,
No?
I mean, yeah, I mean, this is all Buffett's idea. Buffett told him what he was gonna do. Buffett created incentives. I'm sure Harry's getting a lot of good payment from the accomplishing of these goals. But just because you have a vision, you've created incentives, doesn't mean it will happen. And it's just he's acknowledging a great person
Yeah.
who lived up to his expectations.
Expectations. Yep. Okay. I've included above the conversion factors we have previously used in valuing Dempster for PBL purposes.
But sorry,
Yeah, go ahead.
I will say that I mean share price went from 35 to 64. That's more than double now,
Yeah,
and
right.
they own 70% of this. So
Wait,
that's
and they what? 70%?
70% is owned by a partnership.
Okay, okay.
So I mean, and yeah, so that's probably a multi-million-dollar bonus to the
Yep,
partnership.
yep.
Yeah, continue.
Okay. I've included above the conversion factors we have previously used in valuing Dempster for BPL purposes to reflect estimated intermediate sale valuations for non-earning assets. I'm guessing BPL is like a tax consultant firm or something? I don't know.
No, I think it may be like profit loss or something,
Oh,
accounting
okay.
thing.
Okay. Um, as can be seen, Harry has converted the assets at a much more favorable bias than was implied by my evaluations. This largely reflects Harry's expertise and perhaps to a minor degree my own conservatism in valuation. As can also be seen, Dempster earned a very satisfactory operating profit in the first half, as well as substantial unrealized gains in securities. And there is little question that the operating benefits
Business.
as operating business as now conducted has at least moderate earning power on the vastly reduced assets needed to conduct it. Because of a very important seasonal factor and also the presence of a tax carry forward, however, the earning power is not nearly what might be inferred simply by a comparison of the 11/30/62 and 6/30/63 balance sheets. Partially because of this seasonality, but more importantly because of the possible developments in Dempster before 1963 year end, we have left our Dempster holdings at the same 51.26 valuation used at year end 1962 in our figures for BPL's first half. However, I would be very surprised if it does not work out higher than its figure at year end. Okay.
Yeah, so basically, since he's saying our marketable security, our stock portfolio within that company is doing great, and actual business because we've cut down so much, staleness from the company that it's actually operational. In the past, there are a lot of losses, so it looks like it's very very profitable right now, but it's actually not
Mm-hmm.
because we aren't actually paying taxes because we had so many losses before.
Mm,
So in the future, the true profitability is actually less than what the balance sheet will imply.
mm-hmm.
But yes, I mean there's a huge value unlock in this business,
Mm-hmm.
and it's giving Harry the credit.
Yep. Okay. Interesting. So can you explain a little bit about this valuation that he had of 51.26? Is that because he hadn't paid taxes on it yet, so he hasn't changed the
No,
valuation?
that's just the intermediary. He's just like, well, we last year we had was the valuation based on what the assets were sold for, how much were sold, what was left. So I think from $35 per share, I went to $51 per share.
Mm,
And this year, I haven't made any adjustments. I basically haven't done the recalculation yet.
mm-hmm. Okay.
But they include the table from November of that year, so maybe I don't know if that was added in later.
Mm, okay.
But it ended up being 64, which is a huge jump.
Yep. One slight hand, one side light for the fundamentalists in our group. BPL owns 71.7% of
Oh, I get
Dempster.
it. BPL is a Buffett partnership limit.
Oh, of course. Okay, okay, that makes sense. Okay, because they own it, right? Okay. One sidelight for the fundamentalists in our group. Berkshire Partnership Letters,
Buffett.
Buffett Partnership Letters, that's right, owns 71.7% of Dempster, acquired at a cost of $1.2 million.
Hmm.
On June 30th, 1963, Dempster had a small safe deposit box at the Omaha National Bank containing securities worth $2 million. Our 71.7 shares of $2 million amounts to $1.45 million. Thus, everything above ground and part of it underground is profit. I'm sure there's a joke there. I missed it. Okay. My security and analyst friends may find this a rather primitive method of accounting, but I must confess that I find a bit more substance in this fingers and toes method than in any prayerful reliance that someone will pay me 35 times next year's earnings.
Because it's such a liquid stock, he's not valuing it based on what the stock price is,
Okay,
right?
but why
So he's
is
saying
he?
how you value something is, you look at the earnings and you put a multiple to it, a PE ratio. And it
Okay.
looks like it's been trading at 30 PE or close to that. He's saying I don't really care about, when I try to go sell my 70%, am I able to gonna get a 35 PE price? I may not, so I don't care about that because it's a liquid company. So what I
Okay.
care about is actually how do I value this company without the multiple. I just look at all the things, assets I have. I just look at the assets, and that's how I'll value it.
Okay.
So he
Okay.
put 1.2 million into it, right when he bought it, and no, he acquired 71% at a cost. So he valued the business. Uh,
Or maybe he bought it at 1.2 million, I think.
yeah, let's just say
Yeah.
that. And then and as of right now, or 1963
It's 1.4
summer,
million.
yeah, his stake is 1.4 million of just the securities, and then the business is separate.
Okay.
Yeah.
Okay. Advance payments and advance withdrawals. We expect advance payments from partners and prospective partners at 6% interest from date of receipt until the end of the year. While there is no obligation to convert the payment to a partnership interest at the end of the year, this should be intent at the time of payment. Similarly, we allow partners to withdraw up to 20% of their partnership account prior to year end and charge them 6% of the date of withdrawal until year end when it is charged against their capital amount. Again, it's not intended that partners like us, like a bank, but that they use the withdrawal right for under unanticipated need for their funds. Okay.
He's just saying, please don't pull out money like randomly. I mean, like, don't give me money that you need short term just because I don't want the hassle of giving back money to you. That means I may have to sell things I don't want to. Like, I don't need that.
Okay. The willingness of both borrow and lend at 6% may seem un-Buffett-like. We look at the withdrawal right as a means of giving some liquidity for unexpected needs, and as a particular and as a practical matter, are reasonably sure it will be far more than converted by advanced payments, covered by advanced payments. Okay. Why then the willingness to pay 6% for advance payment money when we can borrow from commercial banks at a substantially lower rate? For example, in the first half, we obtained a substantial 6-month bank loan at 4%. The answer is that we expect on a long-term basis to earn better than 6%. The general partner's allocation is zero unless we do, although it is largely a matter of chance whether we achieve the 6% figure in a short-term period. Moreover, I can adopt a different attitude in the investment of money that can be expected to soon be part of our equity capital. than I can on short-term borrowed money. The advance payments have the added advantage to us of spreading the investment of new money over the year, rather than having it hit us all at once in January. On the other hand, 6% is more than can be obtained in a short-term dollar secure investments by our partners, so I consider it mutually beneficial. On June 30th, 1963, we have advance withdrawals of $21,832 and advance payments of $562,000. Okay, maybe we can talk about this for a little bit. So he's giving the justification for why it might be good for you to borrow from the bank at 4%, because he thinks that he can make more than 4%, in fact more than 6%, but not in a short-term period. In a long-term period, he can make more than 6%. He's confident about that. So borrowing at 4% doesn't seem like a high-risk thing for him.
Correct. I mean, and clearly he has that influx of money, right? More money is coming in. He has more advance payments than withdrawal.
Yep.
But I think the incentives are kind of beautiful actually, because he's like, bank will give us a loan of 4%, but I will let you only, take a loan at 6%. In a way, I mean, yeah, go ahead, if you really need the money, get it from the bank.
Mm-hmm.
He's just like, please don't, like,
Get it from me.
don't, yeah, because if you need it, I mean, bank may not qualify you because you're not buying a house or something.
Mm-hmm.
But I think at the end, just doesn't want withdrawals during a scary time, because that's when the opportunities will be.
Yep.
But yeah, that's the
Yep.
best way to sum it up.
Yep. Okay, taxes. There is some possibility that we may have fairly substantial realized gains this year. Of course, this may not materialize at all and actually does not have anything to do with our investment performance this year. I am an outspoken advocate of paying large amounts of income tax at low rates. A tremendous amount of fuzzy, confused investment decisions are rationalized through the so-called tax considerations. My net worth and the market value of holdings less than tax payable upon sale. The liability is just as real as the assets unless the value of the asset declines. Ouch. The asset is given away, no comment. Or I die with it. The latter, of course, of action would appear in the least broader of the Pyrrhic victory. I don't get that joke. I'm sure it's a joke there. But anything
No,
discuss
no.
here? Okay. Investment decisions should be made on the basis of the most probable compounding of after-tax net worth with minimum risk. Any isolation of low biases or low basis securities merely freezes a portion of net worth at a compounding factor identical with the assets isolated. While this may work out either well or badly in individual cases, it's a nullification of investment management. The group experience holding various low bias securities will undoubtedly approximate group experience on securities as a whole, namely compounding at the compounding rate of the Dow. We did not consider this the optimum in after-tax compounding rates. Okay, I've said before that if earnings from the partnerships can potentially amount to a sizable portion of your total taxable income, the safe thing to do is to estimate this year that same tax you incurred last year. If you do this, you cannot run into penalties. In any event, tax liabilities for those who entered the partnership on 1/163 will be minimal because of the terms of the partnership agreement first allocating capital gains to those having an interest in unrealized appreciation. I guess he's really just talking about tax ramifications for their partners. Yeah. As in past years, we will have a letter out about November 1st to partners and those who have indicated an interest to me by that time in becoming partners. With the amendment to the partnership agreement, commitment letters, commitment letter for 1964, estimate of the 1963 tax situation, etc. My closing plea for questions regarding anything not clear always draws a blank. Maybe no one reads this far. Anyway, the offer is still open. Cordially, Warren E. Buffett.
So it looks like nobody
No
has,
one's
contacted
ever,
them.
yeah.
They're like, I'll talk to you, Warren.
Oh gosh, that's so great. Um, yeah, interesting. I think that draws the close for 1963
Yes.
until we get to the second half, which is going to be November 6, 1963 for next time.
Oh, yeah, and that may be a very small letter. And I mean, the major letter will be the one written in January of that year.
Yeah,
But all right, looks like
awesome.
he didn't really say. I mean, he clarified something was Dempster. That was the biggest insight I think that
Yep.
from this letter. So
Yeah, yeah.
and of
So
course
and
he's killing
also
him.
still killing it. Yeah, I was about to say still
But that's
killing
not
it
really
like usual.
that's not news. I mean,
Yeah, yeah, yeah. Pretty incredible.
all
Awesome.
right, guys.
Yeah.
Till
Till
next
next
time.
time.